Welcome to Perspectives Eye. In this video, we will be discussing fintech and money laundering, and we will share with you the risks seen in fintech services, such as anonymous and pseudonymous transactions, cross-border transactions, decentralized finance or DeFi, e-wallets and mobile payments, and crowdfunding. We will offer examples of risks, what to review, and how to mitigate these risks. Pay close attention to our tips and advice on risk mitigation at the end of this video that are applicable to the services that we just mentioned. So to begin with, what is fintech? Fintech is short for financial technology. It refers to the use of technology to automate, improve, and transform traditional financial services. It encompasses a wide range of innovations that leverage technology to deliver financial services more efficiently, effectively, and accessibly. So let's begin with our first service, anonymous and pseudonymous transactions. What are the risks of this service? These include lack of traceability. The anonymous or pseudonymous nature of some fintech transactions makes it difficult to track the movement of funds and identify the individuals involved. An additional risk includes increased anonymity. The use of technologies like cryptocurrencies and mixers can further obscure the identity of individuals involved in financial transactions. Examples include cryptocurrency transactions. Cryptocurrencies can be used to launder money due to their anonymous and decentralized nature. Money launderers can use mixers or tumblers to obscure the origin of funds. An additional example includes peer-to-peer lending platforms. These can be used to launder money by creating fake loan profiles and transferring funds between them. For example, creating multiple borrower profiles and using them to transfer funds from one account to the other. What do you need to review when you're dealing with this particular service? Look for unusual transaction patterns. Review large, unusual deposits or withdrawals, and review frequent small transactions. Additionally, look for lack of customer identification. Review incomplete and inaccurate customer information, any missing identification documents, and lack of proof of address. Let's move on to the second service, cross-border transactions. Risks include complex networks. The global nature of fintech transactions can involve complex networks of financial institutions, payment processors, and other intermediaries, making it difficult to identify and track suspicious activity. Additional risks include jurisdictional gaps. The lack of harmonized regulations and enforcement mechanisms across different jurisdictions can create loopholes that can be exploited by money launderers. Examples include international remittances. These can be used to launder money by transferring funds between countries. A money launderer could transfer funds from a high-risk jurisdiction to a low-risk jurisdiction to avoid detection. Additional examples include cross-border payments. Fintech companies that facilitate cross-border payments can be used to launder money by disguising the source and destination of funds. What do you need to review when you're looking at the service of cross-border transactions? Review high-risk jurisdictions include looking at countries with weak anti-money laundering regimes, and look for jurisdictions known for tax havens or financial secrecy. Additionally, review unusual transaction flows. For example, a complex transaction involving multiple jurisdictions, and look for transactions that do not align with customer business activity. Our third service involves decentralized finance or DeFi. The risks include lack of centralized control. The decentralized nature of DeFi platforms makes it difficult for regulators to monitor and control their activity. Additionally, risks include transparency challenges. While blockchain technology provides transparency into transaction data, it can be difficult to identify the individuals behind the transactions. Examples include smart contracts. Smart contracts can be used to facilitate money laundering by automatically executing transactions without human intervention. For example, a money launderer could create a smart contract that automatically transfers funds between different wallets to obscure the origin of the funds. An additional example includes decentralized exchanges. These exchanges can be used to launder money by trading cryptocurrencies for fiat currency or other cryptocurrencies. For example, a money launderer could purchase cryptocurrencies with illicit funds and then sell them for fiat currency. What do you need to review when you're looking at the decentralized finance or DeFi services? Review suspicious activity on blockchain networks. Look for large, unusual transactions involving cryptocurrency wallets. Review and look for suspicious smart contract interactions. Look for mixing services or other techniques used to obfuscate transaction origins. And review suspicious activity on blockchain networks. Our next service includes e-wallets and mobile payments. What are their risks? The ease of use and accessibility. The widespread adoption of e-wallets and mobile payments makes it easier for individuals to engage in financial transactions without being detected. Additional risks include limited oversight. The lack of traditional banking oversight and the decentralized nature of some e-wallet platforms can increase the risk of money laundering. Examples include mobile payment apps. These can be used to launder money by transferring funds between individuals without involving banks. For example, a money launderer could transfer funds between multiple accounts to obscure the origin of the funds. Additional examples include digital wallets. These can be used to launder money by transferring funds between different accounts and currencies. For example, a money launderer could use a digital wallet to transfer funds from one jurisdiction to another. What to review when you're looking at e-wallets and mobile payments. Review large, unusual transactions. Look for transactions that are significantly larger than the customer's typical spending patterns. Look for frequent, small transactions from multiple sources. Additionally, review lack of customer due diligence. Look for insufficient verification of customer identity and address, and look for failure to comply with Know Your Customer or KYC AML requirements. Also look for unusual funding patterns and lack of investor verification. Our next service involves crowdfunding platforms. And what risks can we see in this service? Risks include large number of small transactions. The large number of small transactions involved in crowdfunding can make it difficult to detect suspicious activity. Additional risks include lack of investor verification. The lack of adequate investor verification can allow individuals with illicit funds to participate in crowdfunding campaigns. Examples include equity crowdfunding. These can be used to launder money by raising funds for fake projects or businesses. For example, a money launderer could create a fake project and use the crowdfunding platform to raise funds that can be laundered. Additional examples include reward-based crowdfunding. These can be used to launder money by raising funds for personal expenses or illicit activities. For example, a money launderer could create a fake charity or personal project to raise funds that can be laundered. What do you need to review when you're looking at crowdfunding platform services? Look for and review unusual funding patterns, such as large contributions from anonymous or unknown sources. Look for frequent small contributions from multiple sources, and review rapidly increasing funding levels without a clear explanation. Further review and look into lack of investor verification, such as insufficient due diligence on investors and failure to collect required investor information. Now we are at the stage of the mitigation tips and advice. To begin with, it is important to have robust Know Your Customer internal controls as part of your anti-money laundering program. Look for customer identification and verification policies and procedures in place. By implementing strong Know Your Customer or KYC procedures to verify the identity of customers and collect accurate information such as proof of address, date of birth, and identification documents. Furthermore, you want to apply risk-based due diligence, conducting risk assessments to identify high-risk customers, including politically exposed persons or PEPs, and monitor them through enhanced due diligence procedures. You also want to apply mitigation controls on continuous monitoring, regularly monitoring customer activity for signs of suspicious activity, including unusual transaction patterns, high-risk jurisdictions, and changes in customer behavior. Furthermore, you want to apply mitigation controls for real-time alerts by implementing real-time transaction monitoring systems to identify suspicious activity and trigger alerts for further investigation. You want to further apply behavioral analytics by analyzing customer behavior to identify patterns that deviate from normal activity and may be indicative of suspicious activity. We love having you here. If this video was helpful, we would love to receive your comments. Your support through a like, a share, and a subscribe is important for us to continue to share more content with you.